check. 1, 2. 1, 2.
Serenity now, Josh.
You got me? What a shitty close today. Some shout outs to the pound. Biff Greeble says it's libation day. What are you ordering? What is that about? Bill Sweet said that today too.
I don't know what that means.
Because tax day is over. Yeah. It's April 15th.
Shitty close, dude. Down 14 basis points. What?
Back to Bill Sweet. We did 605 families' taxes this year, which is 100% growth in households from 2022. That's pretty gangster.
Mm-hmm.
Shout out to RWM Tax. All right, Biff Greebles is here. Andy Cliff said, "Make the market go up, JB." Not really one of my powers. I suppose I could try.
Do better.
But yeah, John Rush is here. I feel liberated from my gains in the past couple of years. Feel you? Chris Brown, Jason Chen, Cliff is in the house. Nicole is in the chat. Thank you guys so much for joining us. This is an all-new edition of What Are Your Thoughts? Michael and I have loaded up the dock with the topics that we think you guys want to hear about. Investors, traders, economics enthusiasts. We got something for everybody today. But first, Michael's going to do a brief ad read for our sponsor, Flat Rock Global.
But first, Josh, I feel like this show, we're getting back to our roots.
Yeah.
Right, the past couple of weeks, we had to be all over the VIX 60. We had to be all over tariffs and turmoil and dollar and rates. But now we've got some stuff in the dock. We're getting back to our roots. We're talking.
Listen, I love the show in a bull market, but I really love the show in a bear market. And I think it's more exciting. B, we're more helpful to people.
I think so. So, all right, we have a new sponsor today. The show is brought to you by Flat Rock Global, a boutique credit manager that focuses on niche credit market interval fund strategies, looking to diversify client portfolios with private credit. Check out Flat Rock Global. They offer 3 funds. 1, Diversified Private Credit, the Flat Rock Core Income Fund, ticker CORFX. Middle Market CLO BB Notes, Flat Rock Enhanced Income Fund, ticker FRBBX. And finally, the CLO Equity Flat Rock Opportunity Fund, FROPX. There's there's $1 billion plus in these strategies. So clients seem to like them. Visit flatrockglobal.com/thoughts. That's flatrockglobal.com/thoughts. Let's get to the show, Josh.
You killed that ad read. I have to tell you.
Thank you, sir.
Slayed.
Thank you.
Was that a slay? All right.
Say slay to quite slay.
This is where I want to start today. Do you remember in circa 2010 to 2013 when we were coming out of the great financial crisis, and every time the economic data had a momentary blip, it was here we go again. And then you had the European financial crisis, and it's early Twitter days, but really it was blogs. There were no podcasts. It was really Twitter and blogs, and people would use Twitter to share the link to their blog. That was the financial media ecosystem. A lot of financial bloggers got discovered by Bloomberg and CNBC and the Wall Street Journal because of all the blogging and all of the tweeting. But so it was a great era for financial content, but one of the downsides was there was a ton of noise. And a lot of the best bloggers like Tadas Visconta and Eddie Elfenbein and Patrick O'Shaughnessy when he was still writing, a lot of the top bloggers, myself included, I think, we would do these posts about how to tune out the noise or why it's so important to tune out the noise. And it was just a lot of stuff about noise because there was a lot of noise. Do you feel like this period right now is very similar to that 2010 to 2013 mini era? I sort of do.
I see what you're going for, but I think it's 1,000 times noisier.
Oh no, yeah, no, I agree. But it's similar though, just in terms of the noise being so dominant. I do think it's noisier now. I think the data is noisier, which actually makes it even tougher. And I think the economic stuff and the market stuff is 100% wrapped up in the political stuff, and they can't be disentangled. And that's where one of the biggest sources of the noise. But that's why it reminds me so much of the European debt crisis. There was all this stuff about austerity and the role of central banks and the U.S. approach versus what they were doing in Europe and German Parliament and the Bundesbank. That's what makes this feel similar to then.
It's macro noise, which is completely
Macro
different
noise.
than DeepSeek noise or earnings recession noise or anything company related. So in that respect, I feel like we didn't really have that. I guess we did with the trade war, I guess, in 2018. But COVID wasn't a macro noise. 2015 Brexit was a little macro noise, but it was across the pond. So I think we haven't really had a global macro noise event since the double dip 2011 era that you're talking about. I also think one thing that's different in a bad way is now everybody is on social media. Like, it was still nascent back in the day. Now everybody's there.
Yeah.
Michael Antonelli had a great take. He said, hearing everyone's thoughts 24/7 is the worst thing to happen to society since the mosquito.
Oh, I think it's toxic. Do you remember Tom? Super nice guy. He did like the research puzzle blog.
Oh, Bracky.
Yeah. Do you remember? And he did this really cool post called "The Cave and the Stream." I might be missing. It might be the cave and the river, but the concept was like sometimes it's best to stay in the cave and not be around the other animals, and then sometimes you go down to the river, like the watering hole, and as you're drinking, you hear from all the other animals that have gathered at the river to drink also, and you kind of need to balance those two things. You can't be totally cut off like a hermit and not understand what people are talking about. You also can't stand at the stream all day and listen to the chatter of 1,000 different animals. And one of the things that makes it so noisy, especially Twitter, is like everybody has their own approach to investing. Everybody has different time frames. Pros mixed with retail, mixed with day traders, mixed with hedge funds, mixed with politicians who are market curious and they want to be in the conversation. And I think that like it's if you're just like stumbling upon this, it's like, oh my God, 500 people in my timeline with 500 different opinions. What the hell do I make of this? And sometimes the answer is go back to the cave. This isn't for you, bro. Like this is not going to help you. Whatever information you're gleaning from other people here, it's just going to confuse you and make it worse. Back to the cave.
Especially if you are looking for something to like calm your nerves or some direction or a North Star, you're not going to find it on social media. It's the exact opposite. If you were nervous and you're looking for like people to calm you down, it has the opposite effect. It is so scary out there.
Michael, how do you tune out the noise?
I don't. I consume all of it.
You do you remember the thing I did about consuming all of the noise and becoming immune to it as a result? You remember that? Not really?
I remember a lot of your blog posts, not this one.
So I did this thing. People like, wait, hold on. You're saying tune out the noise and you're on fucking TV 5 days a week. Because back then I was. Like what? How do those two things jibe? You're in some of the noisiest television segments.
Yeah, you are the noise.
I am the noise. This is how I explained it. The best way I could explain it. And I might have done this on the show before. I might not have. There's this great scene in the Avengers, like throughout the first Avengers movie. One of the gags is that Robert Downey Jr. as Iron Man is trying to wind up who plays the Hulk.
Oh, I do
What's his name?
remember that.
Ruffalo.
I do remember that. Mark Ruffalo, yeah.
He's trying to wind up Mark Ruffalo the whole movie, like trying to get him mad so like he hulks out, and he can't piss him off sufficiently to get him to Hulk out. And he's like, "What's your secret? Like, how are you containing the rage?" And at the end of the movie, there's a moment. Ruffalo looks at him and he says, "You want to know my secret? I'm always angry. Like I'm always mad. So nothing you do is really gonna be the thing that gets me to Hulk out, right?"
What's your point?
My point is I swim in this stuff 24 hours a day, 7 days a week. I read everything. I listen to everyone's takes. I read all the research. I'm in the TV segment. I'm on the podcasts, my own and other people's. I'm so immune to all the noise that it just doesn't make me want to do anything, I think. Doesn't affect me, doesn't sway me, I think. And it's 15 years of this. It's not.
Yeah, I don't know that I believe you. I mean, I know what you're saying, but like you feel.
When was the last time you saw me be like, I just heard somebody say something and now this is my whole belief system?
I don't think it works like that. But it's like a cacophony. Like you take everything in and you absorb it and you interpret it. I think that for practical.
Oh yeah. I agree.
Yeah, practical advice for people that are like, you know what? Yeah, how do I tune out the noise? It's the dumbest thing to tune out the noise. You fucking kidding me? This is the noisiest world ever. But one thing that you can do, like really and truly, if you
Teach yourself not to react to the noise, maybe is the better.
Well, that's tough too. If you follow somebody and you saw them tweet something and you almost impulsively acted on one of their tweets and then you didn't, unfollow that person or mute them. Like remove them from your existence.
Oh, because they're too powerful
yeah,
over your psyche.
Yeah, because there are people that are really smart and that put out opinions and you see their track record and you think like they were so right last time and they said something and you almost acted on it, just unfollow them.
Oh, I have those people. Ray Dalio is that for me. I don't read his stuff. He fucking scares the shit out of me. I just don't read it anymore. I think he's amazing. I think he's a brilliant guy. I saw him on Squawk Box. I turned it off. I said, I don't want to hear this. It's not going to be constructive.
How many times
for what I do?
I'm the opposite. He's been saying 1937 for so long. Like him, I tuned out.
I know, but he has a little bit of a power over me because he's a very effective. He's not even like a market. He's not even like a market commentator anymore. He's more like a historian almost. He's brilliant, and I am susceptible to people that I think are really smart, and there aren't that many. So I don't listen to him anymore because it's not gonna help me do what my job is.
You know what's really instructive to me?
You have one of those? Do you have one of those people?
I do have a few of them. I'm not going to name them, but
am I one of them?
No. In 2012, we were at Barry's Big Picture Conference, and there was some guy on stage. You know who I'm talking about. Don't say his name. He is so fucking smart, and he waxed poetically with a European accent and scared the bejesus out of me. 2012. So I think that if you go through that enough times and you listen to enough people be completely dead ass wrong, you get a little bit not immune but resistant.
Yeah. That was that era. That was like 2011 or 2012, and he was doing this thing about how the Roman Empire crumbled, and it started with the breakdown of trust.
Yeah.
Like the emperors started to mix other metallic alloys into the coins, so they weren't really gold. And then once nobody trusted the currency, it wasn't long before people started ripping up contracts. And listening to that, getting taken in by that, it's already a moment of heightened volatility and you're already nervous, and that just puts you over the edge. Like, holy shit, this is the end of the empire. What about the political? So here's what's weird. Like, you're watching like CNN or Fox News or MSNBC or whatever your drug of choice is at 8 o'clock at night, and they have like Dan Ives on. I can't escape market commentary now. It's on the political shows. Bill Maher is doing tariff shtick. I watch Bill Maher. He opened his monologue with tariffs. I've never heard him open a monologue with market commentary in my life. They got that guy from the New York Stock Exchange that everyone takes photos of, the Einstein guy. What the hell is he doing on CNN? What does he have to say? So that's part of the problem now. So now you have people who don't normally pay attention to markets, and they're getting the market noise in the places that they normally just get regular news.
And think about this: if you are, it's hard enough to fight your own emotions in a bear market. Now you have to contend with everybody else telling you that the S&P is going to 3,700.
Yeah. Look, I think it's one thing to say tune out the noise, but it's another thing. You actually have to define what noise is maybe before you can even tune it out. What right now is noise, and what is signal to you?
To me, right now, the surveys are totally noise.
Surveys.
Show me this one. Let's show this
one. Hard agree.
Yeah.
Hard agree.
So, okay, this is from the Global Fund Manager Survey from Bank of America. Record number of investors intending, okay?
Throw it out.
Intending to cut U.S. equities. Okay, show me what they do. I don't care what they say. Look how noisy this chart is to begin with.
Yeah, literally throw it out.
But here, oh my God, record numbers of investors are dumping U.S. stocks. That doesn't feel great to hear. I don't believe it. Sorry.
It's hundreds of fund managers answer the survey, and they're super moody and like responsive to the mood of the market. They're like way less stoic than you would expect global fund managers answering survey to be. Super emotional. Put that chart up. All right, so when is this noise? Because in 2020, the only two times they've ever gotten this bearish on this particular metrics want to the intention to cut and over to underweight, right? The only two times, 2023, March of 2023, that was during the mini bank panic, Silicon Valley Bank.
Great time to buy stocks.
Great time to buy stocks, but there's one other time, October of 2005, they were right to panic.
Okay.
What a fucking shit show we ended up in
great.
2 years
yeah,
later.
And they bought emerging market stocks, even worse. Here's another one. John, show the University of Michigan one. Now, come on.
This is insane.
So for people that are listening.
Wait, stop. What is this?
It's the percent of respondents making negative comments. Now, listen, I'm just as...
Where? Making negative comments in the survey?
I'm less than thrilled with the current administration's handling of tariffs and their messaging, but you're telling me that it's like almost twice as uncertain as anything that we've lived through over the last 30 years? Come on.
It's the stupidest chart I've ever seen.
Nonsense. Just nonsense.
Wait, hold on. The percent of respondents making negative comments, 60% of the respondents to the UMich Consumer Sentiment Survey. Are they all in Michigan? That would explain a lot. Have you talked to Ben recently?
Right.
Ben's walking around with a black cloud over him because he lives in the manufacturing heartland state, like the automaker state, the industrial state. I've never heard him this despondent as I have over the tariff and trade stuff.
Yeah, he's not thrilled. So all of the survey sentiment stuff says the same thing, but like it's showing hysteria.
It's hysteria. That's a really good. It's almost beyond noise. It's like, oh, this is more than noise.
It's the opposite of euphoria. It's like pure hysteria and panic.
It's pandemonium.
Yeah, So listen, like again, I'm not. This sucks. The tariffs aren't great, and the messaging around them is worse. But it is a lot.
Inconsistent, which also adds to the noise. The idea. So first of all, if you actually go up to somebody and ask them what the tariffs are, or what the tariffs are going on, they have no idea. Because they don't live in it, and they're not as focused on it as we are. They don't know if it's steel, is it oil, is it semiconductors? At this point, nobody knows what the hell is going on, and I think we're going to talk about bank earnings later. But I was struck by Brian Moynihan's response, first in the Q&A of the conference call this morning. Brian Moynihan, CEO of Bank of America. But also, I heard him talking to Sarah Eisen today, and he's just like, look, you're asking me to comment on things that are still theoretical. We have no idea what we just don't know.
Right.
How do you expect me to make a comment on how the tariffs are going to affect the economy or our business when we don't really know what they are yet?
Josh, to that point, did you see United Airlines after the close?
I saw it ripping into the close.
So they ripped so they reported earnings. And they gave estimated guidance for a stable environment and estimated fiscal year 2025 in a recessionary environment. So they didn't pull guidance like Delta did and Walmart did. They gave a range: stable, recession.
So why give guidance at all?
I don't know. I'm just saying. All
right. So I think we agree surveys right now are pointless. People are out of their minds.
Well,
okay. What else is noise?
Not totally pointless, because all of the surveys and the sentiments, including from CFOs and CEOs, are saying the same thing. It's probably not great. Like heightened uncertainty, people are pulling back. People are worried about layoffs and income. They're going to spend less. Projects CapEx is going to come down. So we will see a slowdown as a result of this, but it is over the top.
Right. You could have a slowdown that's not actually a recession, which is what the banks are guiding to. So Bank of America is like, we are not forecasting a recession this year. Things could change. That's our call right now is not recession. This is not their Merrill Lynch guy that does CNBC. No. So this is like the bank's internal forecasting.
If you take the surveys at face value, we're going to a depression.
Citigroup reported too. Let's just hit that here really quickly. We're doing the bank earnings later?
Yeah, we'll do it. Let's put it.
All right, forget it. So
all right,
what are we doing after this?
So I want to talk about the AI spend because are we to believe that these secular trends that are in place, the wheels that are spinning, are all of a sudden going to be completely undone and reversed by government policies?
Are we to believe? See, only a Sith deals in extremes.
Absolutes.
Absolutes.
You're right.
It's too absolute, the question.
All right,
right?
so-
like, we need shades.
So, Vivek Goyal from Altimeter. So Google had a conference the other day. Tweeted, amazing that Sundar Pichai reiterated their $75 billion CapEx guide for 2025 despite the tariff uncertainty. Big tech plus OpenAI realize that this is a generational opportunity and the prize is large enough to continue investing through the macro noise. So, Josh, I want to put a pin in this for 10 seconds, maybe 30, maybe 60. And I want to show this chart from that I pulled up on Quarter. So Alphabet, Google, I asked them, make me a chart showing Google ad revenue by quarter over time. So on the Quarter app, you're able to do this. And this is pretty damn sexy if you ask me. And I am super duper excited / a little bit nervous as a shareholder to see this drop by 12%.
Wait, what is the chart showing?
So this is Google's ad revenue. And this is
in dollars, not
dollars.
as a percentage of the total.
So
Okay.
I think it's very obvious the reason why Alphabet is trading air quote cheaply at 17 or 18 times 25, 15 times 26 is because the street doesn't believe it. Is there an existential threat that they're going to report one quarter a decline in ad revenue because people are actually migrating away to ChatGPT and the like?
I sold Google, the rest of my Google today. Did I tell you that?
Did you? Dude, you didn't, but I was thinking about dumping it too.
I'm out. I'm done. And look, we all have exposure to Alphabet no matter what. It's one of the top 10 market caps in the world. It's in every index. It's in the dividend index, in the buyback index, shareholder yield index. It's in the growth index, probably be in the value index too, depending on the rules of said value index. It's in the NASDAQ. It's in the S&P 500. Everybody has notional exposure to Alphabet via ETFs.
So
right?
I assume you dumped it because of what I just said?
I own the stock. I sold half of it like 2 months ago, close to 200. And that second half was hanging on for dear life because it's not an easy sale for me because I'm super bullish on YouTube. And I'm like Gmail life. Like I'm Gmail, I'm Google Docs. I'm very, very heavily involved in all their products. But I'm watching how my kids are getting information. They're not using Google. So they are Gen Z, and when they want to know the answer to a question, it's never a Google search. It's right into ChatGPT. The app is home screen of the phone, and they don't want blue links. And they don't want sponsored links, and they don't want to scroll down on a web browser to get to the answer ever. They just want the answer.
So you think it's
and I
gonna
don't know
happen-
what
you think it's gonna
percentage
happen-
of search that takes away. I don't know if Gemini can successfully put that at the top of their search results and somehow make money from it. You never had to worry about Google until now. Mm-hmm. The core business, 97% advertising, Google?
No. It's not quite that high, but it's a lot. That's the business.
No. I meant search. Excuse me. The advertising business is right. Like YouTube is huge, but search is even more important because search sends people to
Search is
YouTube.
huge. Yeah.
And then they have the cloud business, which they're the third biggest player, and they make tons of money in cloud and
But
AI.
they're never going to be number 2 or number 1 in cloud. It's all about search.
Right. So I think that they have a less defensible moat in terms of advertising than Meta. I think Instagram is just like a better mousetrap for users and advertisers, and they fight basically this is what I would say. Instagram is in a death struggle with TikTok that could go on for 20 years. One gets the upper hand, then the other, on and on and on and on. Google is now going to fight everybody.
Yeah.
That's the reality. They're going to fight everybody.
But so everybody knows this, which is why it's trading at 17 times forward.
That's why it's cheap.
Yeah.
Cheap for a reason. It's a below market multiple.
But my point is, I'm very excited to see / nervous their next earnings report.
Yeah, so I don't think Google's screwed. It's just they're in a fight. They haven't been in a fight in a really long time. They were paying Apple $50 billion or something in order to be the default search browser on Apple devices.
Well, they fought Facebook. They fought Facebook for advertising dollars.
I feel like they were a duopoly and they did very different things. And I I would guess their top 500 advertisers use both platforms.
Right.
I don't think it was one or the other.
You're right. This is existential.
It's existential. They either watch ChatGPT and a few other LLMs take a 20% chunk out of the search market because they built something, and it's Perplexity and Claude and Llama, and Meta is building search with their own tools. They're not going to pull in Google search ever. Like the avenue is being closed off to them. There was a judge that ruled that effectively what Apple and Google cooked up together, this scheme to make Google the default search, did permanent harm to the market for other search products. Now, you might ask yourself, what other search products? That's the point. Is DuckDuckGo, which promises they're not collecting your data while Google incognito browsers are. That's like how they're advertising themselves. There's nobody else. No one else is left.
All right, so let's put the pit back in that and get back to the AI spend. So Amazon, Andy Jassy wrote a letter this week. Let's throw this up on the screen, please, so I can read it. He said, in part of there, he said, there is also substantial capital investment required in AWS. The faster demand grows, the more data centers, chips, and hardware we need to procure. We spend this capital up front, even though those assets are useful for many years. We only start monetizing this capital investment many months after we spend the capital and over many, many years, which leads to attractive long-term free cash flow and ROIC. Anyway, the point is, like, NVIDIA. That's where this led me to. Like, there's still.
Can I see the end of that? I'm sorry, I hadn't read this.
He said, we continue to believe AI, you're right, I'm sorry, I cut off way too early. We continue to believe AI is once in a lifetime reinvention of everything we know. The demand is unlike anything we've seen before, and our customers, shareholders, and businesses will be well served by our investing aggressively now.
But read between the lines. He's talking about 15 to 20 year payoffs for these investments.
Yeah.
Like, he's telling you. So and he might be right. He knows more than anyone. Nobody knows as much as Andy Jassy about the necessity of investing in data centers. Let's just put that out there. I'm not second guessing. I think what I'm saying is, like, read between the lines. What is he communicating to the sell side?
It's going to take a while to get paid back. By the way, there's also a reason. You know, Walmart is trading at a higher forward PE than Amazon. Like, substantially so.
Yeah, Costco
which as an Amazon shareholder, that does not inspire confidence. I'm not like, oh, great, Amazon's cheap. I'm like, why the fuck is it so cheap?
Yeah, well, I think because Walmart is not trying to spend $1 trillion in data center. Yeah, they're not thinking as far ahead as Amazon clearly thinks they need to.
Does not inspire confidence. All right, NVIDIA. So the announcement this week was, within the next 4 years, NVIDIA plans to produce up to $500 billion of AI infrastructure in the United States through partnerships with TSMC, Foxconn, Wistron, Amkor, and SPIL. Spill? I don't know what that is.
I was impressed by the politically savvy move that this appears on this. Like, it's not, they're not hiding like, ooh, we're doing something for the optics for the White House. They're just like, yeah, this is what we're doing. And AMD followed up really quickly, which is not in the doc, but AMD is like, oh, we, for the first time ever, are going to contract with Taiwan Semi to use their Arizona fab to make some chips for us, because AMD historically has made everything in Asia. So this is where the puck is moving. Everyone now wants in on this TSM fab that's in Arizona. Everyone's like calling them like, we really need an announcement. We really need to shift some chip production into the United States. Intel's not capable or ready. Can you do it? And Taiwan Semi's like, guys, it's not our biggest facility. It's just Arizona. Like, what do you want from us? None of these chips even have to get made, but the press releases have to go out.
Dude, AMD is such a disaster. And at the end of 2020, the stock was trading at $100. It rocketed up to $1.60. Then collapsed to 53. So 100, 160, 53. There's AI. So 53 up to 230. And then from 230 back to 95. It's where it was in December of 2020 with an 80% to a crash. Like, what a disaster the stock is.
The only bigger disaster is Intel. It's the two of them at this point. Do you know? Here's fun fact.
But AMD was supposed to be the number two. It's supposed to be.
I never believed it. I don't buy the second best. I don't buy the number two. That's not how I invest. I know a lot of people that bought Broadcom and that kind of worked, and AMD didn't. But so fine. So there's 1 and 2, but there's no number 3. I don't believe in this. I think tech, telecom, communications. These are winner take all endeavors, and you don't buy number 2. Do you know Intel turned down Apple when Apple was looking for somebody to make the first iPhone chips? Oof. Did you know that story? Can you imagine? Do you know while NVIDIA was doubling and tripling down on GPUs for nonlinear processing, Intel was acquiring a company called Altera. They just sold it to a private equity firm this week. They took a 50% haircut. This is a purchase they made 10 years ago in 2015. I think they spent like $16 billion and sold it for $8 billion or something.
Intel looks disastrous.
It's like the worst.
It's hanging on to $20 for dear life.
A lot of questions about the puppy dog on the bed behind me. It's not Snoopy, although I could see why you might think it is. That is a jelly cat. You know about jelly cats? No?
No.
Your little boys don't play with stuffed animals anymore. They're too old, right?
I don't know what a jelly cat is.
Jelly cat.
Okay.
All right. What else were we doing in this?
I'm good.
Yeah, no, that's look, you're asking the right question. Could a slowdown be pronounced enough where all of this AI spending not only looks insane, which I think to a lot of people it already does, but looks downright dangerous? Like, is that the question? Yeah, I think if we go negative GDP in the second half of this year, and this tariff confusion is still with us, and we're going to talk about in the next topic the way people are pulling back on their spending, it's going to look nuts.
Yeah,
people are going to tell them to stop.
I think it has to get really bad before they slow down.
Like, people are going to tell them to stop, though, if that's the case. If we're in legit recession,
well, their shareholders will tell them.
Well, they're going to tell them by selling the stock.
Yeah, that's what I'm saying.
That's what they told Zuckerberg about the metaverse.
Yeah.
They said, "Can you please stop?" No? Okay. Sell it at any price. So I think that's a risk. All right. Reverse wealth effect. We talked about negative wealth shock on a recent episode.
Yeah.
This is a little bit different. I only want to look at the high end of. I want to look at not the high end. I want to look at the top 20% of consumers, because that's where the action is right now.
Did you watch Your Friends and Neighbors?
No, not yet. Is it good?
These are the type of people. These are the type. It's only 2 episodes, but these are the people.
Okay. There's a Wall Street Journal story over the weekend about people canceling 7-figure home purchases. I have been waiting when this component of the market would finally break down. So just to chart off 1 second, just to bring people up to speed. So over the last couple of months, there have been a lot of stories and a lot of CEO commentary from Target and others saying at the low end, the consumer is like pulling back. Okay. And then it migrated. It was like, yes, the everyday consumer is now being way more cost conscious. People that were shopping for clothes at Macy's are now at Walmart. Like, there was like, but the high end, the commentary was like, they don't give a shit. They just keep spending, right? Especially on travel, on experience, like concert tickets, like no problem selling out the front row of everything. No problem selling first class tickets. No problem selling $10 million condos in Miami. That's starting to break now. And that, to me, is the most notable sign. And this is not noise. So let me read this. In the U.S., the richest 10% have 36.3% of their total assets in stocks and mutual funds. 18.7% is real estate. This is total assets. Until recently, luxury sales were on an upswing. Agents said high Wall Street bonuses indicated a strong year ahead. This is like as recently as January. Overall, the median sale price for U.S. luxury homes, defined as the top 5% of sales, rose 8.8% during the second quarter of 2024, more than twice as fast as non-luxury homes. So that was the environment that we were in. Now, people's behavior is materially changing. The article opens up with an anecdote, as most do, of somebody named Peter Ocean, who was a real estate agent. His clients accepted an offer of $10.25 million for a 4-bedroom co-op in Lenox Hill. That's like the East 70s in Manhattan. And then the buyer's just like, no. And the reason is the client's stocks were down 25%.
That'll do it.
Okay, that'll do it. That'll make you change your mind real quick about...
Especially when they're using their portfolio for a loan.
And the thing is, all of these wealthy people are affected by the same thing. It doesn't matter what line of work they're in. The stock market is universal. And when the stock market... Okay, markets lost $6.6 trillion in an epic two-day rout, April 3rd and April 4th. Fallout in the high-end real estate market has been swift. And then the tariff announcements, and then all of a sudden they're getting all these quotes from all these realtors at these highfalutin firms, and it's like, yeah, people are backing away, prices are being cut, and this is that negative or that reverse wealth effect in action, and it doesn't take long, which I think is the salient point that I want to make here. Are you surprised by any of this or not really?
Not really, but I kind of want to see what happens actually in the data as opposed to the anecdotes. I believe what they're saying, but we need more time.
Here's data. They quote a guy, Stephen Shane of Compass, who's like the big wheel in Aspen real estate. So you assume the Aspen real estate market is fairly insulated from pretty much anything. It's like all moguls and okay. This guy said he saw $100 million worth of real estate return to the market since April 2nd. It's a week ago, including one of his listings, a 7,900 square foot house that was asking $52.5 million. It was listed in December. It was marked pending on February 24th, relisted on April 8th. So that's a sale that fell through. Like, I don't know if that's data. It's another anecdote. But, like, these people are – realtors do not want to get quoted in the Wall Street Journal about the market being soft. This does not help any of what they're trying to do. So this is where we are now, and I think it's material. I don't think it's noise. Two more things. This at the Javits Center this week, 32,000 hairdressers, colorists, salon owners, beauty technicians. They did their annual industry convention where they, unveil new shampoo. Here's a quote. "It's feeling a lot like 2008, said Christy Powers, who's worked through 3 economic downturns since 1999. So this is a salon owner in Maryland and saying, our workers, now there are probably a lot of federal workers, coming in to tell me how stressed they are, halting services to save cash. Another quick quote from here. So again, this is the salon customer. These aren't coal miners, guys. This one owns a salon in Massachusetts. Quote, "People don't like to walk around with roots showing. Clients who previously got color every 2 or 3 weeks are stretching it to 4 or 5, citing the political situation and implying they've lost money in the stock market. They're cutting back in other areas as well, so it's not just us." And she's been in the business, says 28 years. So that's a thing. Last, Louis Vuitton. Did you see this?
I did. I have some stuff to say about this.
Okay. Not disastrous, but also not what it was last year when they couldn't keep...
The stock is disastrous.
Yeah, the stock's disastrous. They could not keep luxury goods in stock. 2 summers ago, I was in Italy. I was in Amalfi Coast. People were lining up in the morning. The boat would come to Capri, drop off all these luxury goods. They would bring it all the way up the mountain into the store. The store would be empty 2 hours later. And everybody wants to leave Italy with something leather. I mean, Prada, Gucci, Fendi. These stores would get cleaned out by lunchtime. You had to get in line before they opened, and there was nothing left in the store. That is not what's going on. Louis Vuitton just said, other than champagne, everything is down. They own Louis, they own Dior, Bulgari, Hennessy, everything is down. Sales down 3%, and they don't see any sign of a recovery in sight. They have stressed customers. Let's put this chart up.
So the stock is down 45%. There's another thing going on in here. So yeah, organic sales down 3%. Not great at all. Wines and spirits down 9%. Fashion and leather goods down 5%. Watches flat. Perfumes down 1%. Not great. There's another part of this though. Show that luxury titans chart by quarter. Next chart, please. There we go. For the first time ever, Hermes has a larger market cap than LVMH, which is kind of nuts considering the next chart. So yes, Louis is not in a great shape. I don't know if this is more about Louis specifically. It's probably a combination of factors, but it's also Hermes eating their lunch. Look at the head start that Louis had on this company. It's remarkable.
Well, there's another company that reports earnings called Kering.
What do they
I don't know
have?
if their report is out yet for this quarter, but they own Gucci. I think they own Cartier and Montblanc. They own the luxury brands. They own the luxury brands that Louis doesn't. There's like four European luxury companies, and they own everything. And then here in the United States, I guess we have like, I don't even know, Ralph Lauren.
But my point is the chart for Hermes looks healthy. So I don't know if this is just a Louis story. We'll find out.
All right. My opinion is it might just be, it's not disastrous. It's tough comps. Last year and the year before, these luxury retailers shot the lights out.
Yeah.
So right now, it doesn't, look, the stock's down 45%.
It's a lot.
So it's a lot. But again, this like feeds into this idea that something has materially changed. Even Kathy Wood. Kathy Wood is out with a recession call. I'm not going to read the whole quote. She does this thing about the tariffs and GDP and capitulated to the interest rate. She's saying one sector of the economy after another since 2022 is falling like dominoes because of that interest rate shock. And that now it's going to be like, it could be economy-wide. And here, this is the last sentence. Now that much of the economy is seized up in response to the fear of tariffs, the drop in activity is likely to be more severe than otherwise would have been the case. And then she calls for tax cuts, deregulation, and lower interest rates, which I believe all three are on the way. Last thing, why is this so important? This is a Warren Pies chart. We were batting it around in the Slack yesterday. Guys, it's binary. After the S&P 500 falls 10%, you either have a recession or you don't. If you don't have a recession, you should just be buying every stock you can get your hands on. That's that teal-colored line. Warren says, keep it simple. No recession means correction is a buying opportunity. This is an amalgam of all of the 10% S&P corrections that did not coincide with a concomitant recession. The purple line is when there is. And as you can see, that's a nightmare scenario. Just absolute torture. Every dip, every rally is sold. So that's why this is so important. Are we in a correction that's just a buying opportunity, or are we in a recession correction, which is a much different thing? Do you agree with that?
Yes and no. Two things. So Warren has another chart that breaks out those lines individually, and it's not as binary as it looks, but it's still a valid message. If we don't get a recession, more or less buy everything. The other point that I want to make is there are some shades of the end of 2022 or the beginning of 2022 in here where everybody knows. Now, there was extreme uncertainty about ultimately what the levels of tariffs are going to be, but corporate America and Main Street is getting a warning sign. Prepare for X. Now, it would be helpful if we could actually prepare for X, but the point is that everybody in 2022 put their head between their legs and braced for impact. And just by nature of doing that, it changed the outcome. Now, I'm not saying that it's going to be the exact same thing, that we're going to avoid a recession because everyone knows one's coming. But when you have this sort of forewarning, it might help dampen the impact of what could otherwise be a disastrous outcome.
I agree. Like, you could get so cautious, and then if there is no recession, the exhale is like a new bull market.
Exactly.
I know that that's possible because we just lived through it. You're exactly right. But I do worry about another externality is if everybody thinks there's a recession and they stop spending, you will have one.
Yeah.
So I don't know how you. I think it has to do with employment. Like if everyone thinks there's going to be a recession, but there aren't any layoffs, you probably don't get one. If everyone thinks there was a recession and they think it long enough for the hiring to slow and then go into reverse, you will get one. Well, I think it's a duration 100% of pessimism.
Right. You're 100% right. If we don't see layoffs, now what's the time frame? Like, what if we just don't see them for the next 8 weeks?
That's a great question. You know what? Dubravko Lakos came on halftime report today. He's sort of bearish. J.P. Morgan, macro, whatever. And he said the longer this uncertainty persists, the more of like a fait accompli this is just going to be. Like the recession becomes unavoidable if this uncertainty lasts long enough for it to force a recession.
Yeah, but we will get announcements for better or worse.
My point is, we had that scare in March of 23. The FDIC came in, resolved 2 banks, saved 3 others, and sold them off. Too fast for that panic to A, infect other financial institutions, B, change anyone's buy the dip behavior. And as a result, that panic didn't turn into a full-blown bear market or a recession. If this continues for 6 weeks and the message just keeps reverberating amongst CEOs, stop hiring.
No, nightmare.
Stop hiring, start cutting. That's why the shit coming out of this administration has got to get more on point and cohesive.
Yeah, we need some clarity, even if it's not great. Like, we just need some finality of what it's gonna
almost
be.
like every tariff I've announced is now on, and there will be no new ones. Live with it. The market would like that.
Yeah.
The market would like no tariffs. I understand, but that's probably not going to be the outcome here. So this is the new environment. I'm not making changes. Get acclimated to it. I think we could escape without the real thing, without the real recession. 6 more weeks of this? I don't think so. So I hope somebody's listening.
Duncan just said NVIDIA's down big after hours. No, it's not.
Yeah, I'm seeing that in the chat.
Is it
I'm seeing that in the chat.
Is it 107? It's down 4.5%. I mean, it's not. No, it's not.
All right, we can't. See, this is the noise that we're talking.
I thought
Duncan,
don't skip.
Duncan.
I thought double down big is like down 13%. Down 5% is a flush wound. All right, let's talk banks. So I listened to J.P. Morgan. I listened to BlackRock, Goldman, and Morgan Stanley, and I didn't listen to Bank of America. But
that's the only one I listened to.
They're all saying like ish the same things. I think it's noteworthy that J.P. Morgan just continues to be the winner in terms of its share price. Chart on, please. This is year to date, down a measly 1%, just absolutely lapping the competition. It's pretty remarkable.
You know, this is back to what I said earlier. I buy number one.
Yeah. Yeah.
I know that there are trading opportunities in these bank stocks, and over any given 3-week period, Wells Fargo rallies more or whatever. That's fine. That's somebody else's sport. I don't play that sport. I've owned J.P. Morgan since the London whale. You understand? And the dividends are buying me more stock. I want it to go down. So that's what I'm doing in these banks. I thought the Moynihan commentary was notable. He's just like, look, we're on watch like everybody else, but it's just not showing up. I think they said credit card spending was up 4% year over year. Now I don't know how much of that is because prices are up and it's just people doing the same transaction but spending more dollars.
That was as of March. Meaning that it's like decent.
Sam Nowak is telling us, NVIDIA says the government has banned them. What?
From selling H20 chips to China.
They're taking a $55 billion charge.
No. 5.5.
5.5.
5.5.
All right.
Not nothing.
That sounds more realistic.
Not nothing. Okay. I pulled out a few quotes that I want to get to from the CFO of JP Morgan. Chart on, please. All right. The main thing that we see there is what would appear to be a certain amount of front loading of spending ahead of people expecting price increases from tariffs. So ironically, that's actually somewhat supportive, all else equal. But I think what it sort of highlights is that during this transitional period and this elevated uncertainty, you might see some distortions in data that make it hard to draw larger conclusions. Chart off, please. Josh, I mentioned this last week. The data is going to look very, very noisy.
Yeah. That's the noise. It's like, oh, there's a spending burst. No. This is people that need supplies before the tariffs go on.
Dude, what if Apple just got an upgrade cycle because of this?
I know. Apple disclosed today that they flew in
6 million planes.
$5 billion worth of
Yeah.
worth of phones.
Yeah.
On 3 different flights or something like that.
Yeah.
I think they flew in a huge shipment from India. India is now making 20% of their phones, which I did not know. I was not aware of that. But
Cobbling the pieces together.
Right. So if you need, I don't know what people make. Like one of the companies I was talking about today on TV, Fastenal, they got stung bad. They have to buy a ton of steel. Fastenal is basically making construction supplies and equipment and literally fasteners, like anything you could think of. They got hurt bad in 2018, and they resolved that if there's another trade war, if there's another tariff thing going on, they're going to be ready for it with their a new and improved supply chain. You picture a company like that, they're like, oh no, we're not doing that again. There's going to be tariffs starting next month. Let's go to work. Let's pull in everything that we need. Like, that's a really great point that you made. Some of the data that we're going to see is just irrelevant or pull forward, and we don't know what's what yet.
Well, the funny thing is, like, all of these earnings seasons that we're entering, throw them out the window. Who gives a shit what these companies did in the first 3 months of the year? Completely irrelevant. I know it's always forward-looking, but now it really is forward-looking.
Yeah,
the results
now it really
don't
doesn't matter at all. God, that's why last week one of the themes we were talking about that's dangerous is yanked guidance.
Right.
Because it's all we have to go on that matters.
All right, next quote from Jeremy. He talks about the low-end consumer. I thought this was interesting. When we look at our card data and also our cash buffers and people's checking accounts, of course it is true that it is relatively weaker in the lower income segment. But when you take a step back and you ask, are we seeing signs of distress in the lower income segment? The answer is no. So sure, the margin cash buffers are lower and you see some rotation of spend, and spending is a little bit weaker than it was in the peak spending moments. But actually, some of the increases in spending that we're seeing in April are actually coming from the lower income segment. So no evidence of distress, I would say. Very important, I think.
Who is that? That's JP
Jeremy.
Morgan?
Yeah.
Yeah. Yeah, I mean, there are signs of distress, but not like extreme. Like some of the stuff about like car loans and delinquency, it's like just barely lifting off the bottom. It was bumping along the bottom for so long, like an L shape, and now it's just starting to lift off. But it's not big enough to say that there's like true stress in that segment. I know people are stressed out. We mean financials. We mean like an economic term. You don't really have stress there yet.
So DJ Solomon from Goldman Sachs was, in the opening remarks, was very much dancing around the ire of Trump, talking about the need for like some sort of reform, but also like we got to be careful. So the important thing there was their investment banking fees were down 7% quarter over quarter, like every other investment bank, but their fixed income and currency and commodities trading was up 61%. Smash.
Tons of trading. The problem, of course, with that is that Wall Street doesn't really give you a multiple on your trading profits because they don't believe they're real.
No, it's temporary for sure. Morgan Stanley Wealth Management. This was interesting. I didn't get any color on this on the call, but chart on please, so I could take a read this. Total client assets at the end of the year was 6.2 trillion, give or take. And fell to 6 trillion, down 3% quarter over quarter.
That's interesting. How?
Especially considering the fact that last time we spoke about them might have been, I don't know if it was last quarter or a couple of quarters ago, 20% of their assets, client assets, were in cash. So I'm curious as to what it was that led to that big of a hit.
I got some highlights on the Citi call. They're
killing it though, by the way. Morgan Stanley Wealth Management.
Yeah. Citi said investment banking revenue increased by 31% to $934 million. I guess that business is small, and so it can post a growth rate like that. It's like small relative to Goldman Sachs.
Well, Goldman Sachs was decent, and they did the giant Google deal, and there was another giant deal that they did there. So if you pull those out, it's probably way weaker.
Yeah. Same thing, equities trading strength. Trading revenue jumped 32% year over year. 6% decline in fixed income trading. This is Citi. And then they said wealth management revenue grew 9%. And I said, Citi does wealth management? They did. Do you know about this?
Is it like the legacy Solomon
No,
business?
they sold Smith Barney to the joint venture with Morgan Stanley, and Morgan Stanley took the whole thing over. They must have restarted.
Is it like
They must
private
have
wealth?
restarted wealth. It's probably like in the branches.
Yeah, it's got to be in the branches. All right, check this out from Quarter. Try it on. This was sick. From Wells Fargo. I asked, how is the mortgage business doing? And they, through their AI bot, they give you a million different things, and I clicked on one of them.
Mortgage business.
Mortgage loan originations actually increased 26%.
Oh, okay.
But here's the we continue to streamline the business. That's one way to put it. Oh boy. Streamline the business with headcount down 47%.
Yeah.
Holy shit. So there is an absolute ice age in the mortgage origination business. Obviously, by the way, I told you, Josh, I bought Rocket with you.
Yeah, we're buying that stock at the very bottom. I don't know if there's a turn, but this is as bad as the mortgage business gets.
I just think that I don't believe that rates are going to stay high. I don't believe it. I think they're going to come down. I think there's going to be a refi explosion.
You're not getting stagflation for an extended period. If the economy sucks, the price of everything is going to drop. That's it. 'Cause demand goes away.
Yeah.
So I think the refi boom is probably more likely than a new origination boom in a bad economy. But I think the refi boom is good enough for some of the stocks that we're talking about.
All right, this is mildly encouraging. So Nvidia is down 6% after hours. The Qs are only down 1%.
That's a very NVIDIA-specific story, selling GPUs to China. It doesn't really affect anybody. All right, I want to do this thing with Uber and Waymo. We don't have to spend a lot of time on it, but I think it's an important story because we talk about autonomous vehicles and robo-taxis on the show a lot. Really interesting thing happened. The guy from Waymo came out talking about the adoption rate in Austin. And Austin is now ground zero for the battle that's about to take place between Waymo and Tesla Cybertaxi. Austin is where Tesla is launching. They say they're launching in June. It's a really key city for tech people, for media people. All eyes are on Austin. And I thought this is really interesting. Waymo robotaxis made up 20% of rides offered by Uber in the city of Austin during the last week of March. That's pretty nuts, dude. So in other words, Uber and Waymo launched in partnership. If you go to get a ride on Uber, on the regular Uber app, just like you always do, they might send you an autonomous vehicle and not a human.
I wonder what the price is. Is it more or less
They let
expensive?
you opt out if you don't want the autonomous, but they don't tell you to choose it in advance. Do you understand?
Yeah.
It's a negative consent. It's like you have to say no robot after they assign it to you. In a place like Austin, everyone's drunk all day anyway. They're probably like, yeah, fuck it, send the robot. I don't care. 20% in the last week of March of all the Uber rides were Waymo on the Uber app.
Yeah, that's remarkable.
That's pretty dope.
People want to try it.
It's a faster adoption than the Waymo only, which they've done in San Francisco and elsewhere.
So is that the bull case for Uber?
That's the bull case for autonomous vehicle companies like WeRide, maybe someday Tesla, certainly Waymo, wanting to launch in cities with Uber rather than just all by themselves. And that's my thesis on Uber, is that in the end, these companies are spending billions of dollars to put these things on the street. They want them to be used.
I wonder what the economics are of the deal between Waymo and Uber.
Well, one of the interesting things about that is there's a service component, and Uber's in that business, where you have to house these vehicles at night. You have to refuel them. You have to maintain them. You have to change the oil. You have to clean them. You do need human involvement. You do need what's called fleet services. And so Uber's in that business. And so that's another reason for a provider of the vehicles to partner with Uber. They do fleet management, fleet maintenance, and they'll make sure that there's a constant flow of people using the cars so that you don't have them just sitting out there on the street waiting. This is interesting. Alphabet's autonomous vehicle unit has racked up 80% more driverless rides in its operating zone in Austin in the first 27 days than it did in the first 27 days of the San Francisco launch. So, like, Americans in general are just getting more comfortable really, really quickly. Put this tweet up. This is Alex Immerman. He's from Waymo. and he's basically saying that working with Uber and Uber running fleet ops and is the first rideshare partner with the driver of the future. This is the guy that's did the data collection, I should say. And then the guy from investor relations at Uber retweeted it, and this guy's an Andreessen Horowitz partner. That's who tweeted this. Last thing on this. So my take is Uber is going to be a great partner for companies that want to launch autonomous vehicles into a given city because they have the ridership, they have the fleet maintenance operation, and they know all of the data about who gets picked up when, how much money you make in each neighborhood. They have all of that work done. So coming into the market with your own autonomous vehicle is great, but plugging with Uber is probably the cheat code. And they're going to launch together in Atlanta now. That's the next city of the combined Uber Waymo thing. And we'll see how that goes. If that looks similar to Austin on the East Coast, that's going to be really interesting, I think, for shareholders.
You know what's good we haven't seen yet is people get hysterical, understandably so, when there's an accident with the driverless car. You haven't really seen many of those headlines, which speaks to the advancements in the technology.
Can I have this chart, John? This is the adoption speed. This is the cumulative Waymo ride volumes in Austin were 80% higher than San Francisco in the first 27 days. You see the black line, Michael?
Yeah, it's remarkable.
So that's the Uber Waymo combo. The pink line is Waymo by itself in San Francisco. So that's what we're anyway, Uber is selling, I'm long the stock in case you couldn't tell. Uber is now selling at 15 times the next 12 months earnings expectations. They're expected to grow earnings 36%. Not a lot of 15 multiples on 36% growers in the NASDAQ. And the only reason it's not 25 times earnings is because of this fear that they're going to get boxed out of their own dominance.
I also own Uber with you. And it's funny because every time they talk about Waymo, the company drops as if it's a threat. But your point this whole time has been, no, it's an asset.
They're working really well together.
We'll see.
All right, you're up.
Okay, I'm going to make the case for the following. It's a bit long-winded, but bear with me for a second. All right, this is from Jay Capel of Sentiment Trader. I believe we touched on something similar to this last week. It says risk on, risk off indicator. I don't know what exactly is in here. It oscillates. It's noisy, of course, but this is some sort of fear metric, okay? And we hit an extreme last week, and 1, 2, 3, 6, and 12 months later. Now, careful because n equals 1, 2, n equals like 7. All right, so 100% hit rate on n equals 7. Take that for what it's worth. The point is, people bought the panic. And so for every data point like this, I can show you the next one. There's a yin to the yang, which shows following its largest 15 daily gains. Next chart, please. The U.S. stock benchmark was higher 6 months later, only 43% of the time. All right, so hardly a slam dunk, but obviously last week, people did a lot of buying. You saw that in the leveraged ETF flow space. But there are and also there are stocks that are making a lot of 52-week lows. 52-week lows, as we know, are a dangerous spot to buy, but people love to buy it. I love to buy some of them. I wish I didn't. Can't help it. But this is where we are. This is a great chart from Grant Hawkridge. He tweeted the stock market, 52-week new lows, expanded to its fourth highest level over the past 17 years. So we got a hell of a washout. Okay. Here's the point that I want to make. You have to know what you're buying, obviously, but you have to know why you're buying. When you are buying into a panic or when you're buying a 52-week low, you really have to have a game plan. Meaning, all right, am I buying this because it's a piece of shit that is so stretched that I'm going to sell the snapback and get out at 20% rally? Or am I buying something that has held up really well, that has shown relative strength, that has dipped because I've always wanted to own it and now I'm in this and this is not a trade? So for example, last week, I bought CrowdStrike. Chart on, please. CrowdStrike divided by the S&P. So CrowdStrike has outperformed over the last couple of years. It's shown really great relative strength into the sell-off. And so I bought CrowdStrike with no plans of selling into the rally. Okay. Conversely, last week, I bought Apple. Apple has been a piece of junk compared to the market. It's gone nowhere, literally. It has gone nowhere relative to the market for the past 3 years. It's not a leader. It's gone up. It's had good runs. It's had bad runs. But last week I showed this chart, the worst rolling 4-day period of all time since the dot-com bubble burst for Apple was down 23% in 4 days. I bought the panic and I sold the bounce. I was in it for the bounce, and that was that.
So you're saying like you had a different thought process about what you were doing with CrowdStrike versus what you were doing with Apple.
So my point is, if you are one of these people, and listen, in an environment like this, you have to have a good reason to buy an individual stock, right? Especially if the index is giving you a 20% sale, right? Yeah. You could buy the NASDAQ down 25%. There better be a good reason why you're buying an individual stock and not the index. So if you are going to be buying individual stocks, you have to have some sort of a strategy. Know your time frame, know what you're buying, and know what you're going to do. Like, in other words, if this goes lower, am I going to panic? Well, then don't buy. Like, you have to have some sort of a game plan going. This is the type of stock that I like it at 100 and I'll love it at 90.
Did you have a stop? Did you have a stop on that Apple purchase, or you were going to stay long no matter what because it was so oversold when you bought it?
I would have continued to add if it crashed more.
Okay. What about CrowdStrike?
CrowdStrike, I'm not selling.
No. So all right. So you had no mental stop. You had no downside protection in either of these names.
Nope.
One of them you would have kept adding to.
Yep.
Okay. All right. And you knew that going in. Would you have honored it?
Kept buying down?
Yeah. You bought Apple at 170?
I bought it at 170. I sold it at 210.
At 150 you're adding to it?
Yeah.
Or 120?
Oh, yeah.
Yeah. Okay. All right.
I mean, that would have been that. Listen, I want to say that'd be my preferred outcome because obviously there's a lot more bigger things on the line than me adding to a trading position. So I'm happy that it worked out this way. But my bigger point is you have to know what you're buying and why and what your game plan is.
And this has been another edition of Balding Alpha. Make the case.
Thank you.
Thank you, Michael. I have a mystery chart for you.
By the way, I also bought NVIDIA. Now I'm not sure what to do. So I guess I need a better plan.
Yeah, maybe get off the podcast and go manage risk. Put this chart up for me, John, if you would. No hints. What is it? No, I'm just kidding. Well, all right. As you can see, I left the y-axis intact. So you can see this has a percentage attached to it. I'll just tell you.
Yeah, I know what it is.
Straight up.
Okay,
it's an interest rate. It's 6.62%. What am I? We're looking at is a 10-year look. What am I?
Are these mortgage rates?
Look at you. Wonderful job. I knew you'd get it, but I didn't think you'd get it that fast. We have a 1-year look at this too. Just keep this up. This is the 30-year mortgage over the last year. Gun to your head.
Lower.
This sees 6 before 7, right?
Yes.
This is the most obvious thing in the world to me. Why are people out of their minds?
In fact, by the way, it would be kind of hilarious if we're wrong because what I'm about to say is pretty ridiculous. I don't know what would have to happen for it to go to 7. It would have to be just
not going to 7.
It would have to be just a dump of treasuries, which would be awful.
The risk here of us being wrong and mortgage rates not falling is that even if the 10-year falls, mortgage originators don't feel comfortable making loans.
That's
right. That's nonsense because Fannie and Freddie are backing conforming loans. Like 95% of the market for mortgages is federally backed.
Nonsense.
So I don't even think that's a real risk. I think this is almost. There are a few things in life that are a guarantee. I think it's a guarantee that the next 50 basis points in 30-year mortgage.
I wouldn't go that far.
I would.
Okay. Here's what I'll say in conclusion for the show. We had the VIX spike to what?
Do the wrap ups now?
I'm wrapping up. Chill out. We had a VIX spike to 60. It's now back to 30. The ability for tariffs to shock the market is probably behind us. It definitely doesn't mean that the bottom is ultimately, and I have no idea. But I think that like the grand pronouncements that have spooked the shit out of investors is probably not going to happen again next week.
Yes. Now we're just left with the garden variety. Will we or won't we have a recession debate?
Yes.
Because the ability of tariff announcements to shock the market may be lessened, but the ability of tariffs to damage corporate earnings very much still with us.
Now let's see reality. Totally
All
agree.
right. Guys, thank you so much for tuning in. This has been a supersized edition, not on purpose. We just had so much to say. We love you guys for coming to the live. We'll see you next week and every week, hopefully, for What Are Your Thoughts live at 5 p.m. on the East Coast. For those of you listening out in podcast land, we appreciate you too. Please leave a rating and review. Remember, tomorrow is Wednesday, all new edition of Animal Spirits with Michael and Ben. We'll do Ask the Compound live on YouTube later this week, and an all-new edition of The Compound and Friends with a very special guest you are definitely going to want to hear from this week. Keep it locked on The Compound all week. We love you. We appreciate you. We'll talk to you soon.